Hello and welcome to Morningstar. I'm Emma Wall, and here with me today to share his 3 stock picks is Simon Brazier, manager of the Investec UK Alpha Fund. Hi Simon.
Morning.
So what's the first stock you'd like to highlight today?
Relex, which has changed its name from what used to be the old Reed Elsevier business. And to me, this has been a very long-term holding in my fund. It's a very high-quality business. And what it does, a variety of things, but it basically uses data and information in a variety of sectors. So a lot of that is around academic journals and the legal business, where it has a big catalogue going back tens, if not, maybe 100 years of the legal business around some of the case law, scientific journals like The Lancet you may be aware of. But it also has a risk and business analytics unit, which is growing significantly, 5 to 10% growth a year at the moment, as it does things like know your customer and anti-money laundering, as compliance is becoming an increasing part of our lives. So, and those businesses have pretty steady growth. They're not that cyclical. Yes, there's some risks to academic journals as people worry it may get disintermediated by the internet, but actually I think that back catalogue provides a bit of a moat. Finally, it does have an exhibitions business which is more cyclical, but the majority of its business is in those core areas which are growing, decent margins, good valuation, good long-term holding for me. And
that, as you say, has been a long-term holding. What about something more recently that you've bought?
Yes, I'm amazed I'm actually saying this to you, but recently we bought FeverTree, the premium mixer business, mainly tonic. The reason for that was purely valuation. I've looked at afar at this, as this company's done very well, but the shares nearly halved just before Christmas, and it gave us an opportunity to buy the company at a valuation that we think more than makes up for the growth opportunity. Just to put it in context about growth, this is a company that grew over 50% in the UK at sales last year. Now, we're not expecting that forever, but it has a real opportunity into the US now. They've signed up with the biggest distributor in the US called Southern Glazer, and interestingly, in the US, it's not just about tonic. There they have a variety of mixers, particularly ginger ale, because people in the US like mixing that with vodka and whiskey. But again, we think this is a company that can grow easily double-digit for 5+ years, and the valuation, very cash generative, and the valuation we were able to buy recently at, we think, gives us downside protection.
And for people who are unfamiliar with the stock, why did it halve just before Christmas?
Well, there's no if you were sitting at FeverTree and you were the management, there was nothing you would see that was any different in your business plan or your revenues. It was purely the fact it got way too expensive. I mean, it became a very, very expensive company, and which is why we didn't own it. But actually, now the shares have halved, and there was risk in the market. People were very concerned about these high growth names, where a lot of the value is, we're saying, the terminal value. It's not the value today; it's what the company could be. But actually, now you're seeing this business on a much more reasonable valuation.
And what's the third and final stock pick?
Well, again, it's another one that I've owned for a long period of time. It's Smith & Nephew. And the other reason I put this company in as a pick is because I do think there's a lot of uncertainty in the world. But Smith & Nephew has 3 main areas. Historically, it was what's called an orthopedics business. It makes hips and knees that go into implants. But it also has been growing outside there. So orthopedics is only about 1/3 of their business now. Another third is in wound management, and another third is in surgery, particularly around things like sports medicine. And so there's quite a nice diversification to this business. And the reality is that people's hip replacements or injuries or trauma do not reflect what's going on in the world's economies. It's pretty anti-cyclical, funded by mainly a lot through government and private healthcare, and it has very strong positions globally. This is a genuinely global business, and not only is it growing its revenues from its product set, but also it's improving margins. Management is getting on top of its cost base a bit better. So to me, it's a very good long-term steady business. Probably one of our best businesses in the UK, I think, in terms of the product set, that can grow revenues, improve margins, and generates good cash flow.
Simon, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.